Alright folks, this is a brief introduction video onto the private school and how it's going to work. The objectives of the video are to tell you how the system is going to be, how I'm going to teach, where I'm going to post, and secondly, and more importantly, is your role as a student. Because I can give you the Holy Grail. I can give you Enigma. I can give you a 100% win rate strategy. But if you don't do your part, then it's pointless. And you will still fail perpetually. So first things first, I'd like you to get a notepad out and start writing down every single word I'm saying. And then later on, you can go and filter out the important stuff and work on that. So let me start with what this is. What this is a comprehensive study encapsulating the importance of time. It is a study guide on how to unlock new dimensions of understanding in technical analysis. And it'll be a look behind the curtain onto what a successful analyst and trader represents and embodies. What this isn't is a holy grail for the lazy and complacent. This is not a pastime activity. This is serious business, as you've seen by my results and my students' results. There is a lot of money to be made in the markets, but only for those who are diligent enough to study. And this isn't some random Twitter course. This is the truth of the markets. So treat it adequately. Most people have a tendency to join a course or join a school and thinking that the rest will figure itself out, which is not true. Step one is joining, which is a good initiative. I appreciate a studious person. And the fact that you joined to begin with is testimony to your, at least they exists a will, right? There is a will somewhere. So clearly you have intention to improve, but don't expect to improve just by paying or just by joining. You join, that's step one. Step two is absorbing the information, staying diligent, and not stopping midway. If you start this, finish it. Now, learning and transferring knowledge is a two-way street. There's a teacher and there's a student. So I can give you my part, but if you don't do your part, then you are destined to fail. My part is I'll be explaining to you how to formulate your own model. I'll be revealing to you what to focus on. I'll be pointing out to you where most traders fail. Your part is, first of all, avoiding multiple sources of information, controlling your attention, right? So you know when you're going on Twitter, for example, and you're scrolling on Twitter, then you're consciously filtering out the people you're following. You're consciously filtering out, if you notice, I'm only following 6 people, and I'm thinking of narrowing it down to like 1 or 2, even less, 0. But you have to be consciously filtering out all the shit information you're getting. Because the more people you learn from, the less you learn. The more distracted you are, the less you learn. The more scattered your attention is, the less you learn. And a form of scattered attention, which I'm pretty sure a lot of you have, you may have it, which is following multiple sources of information. Choose one mentor. In this case, you've chosen me. Avoid anyone else. The only person I would recommend pairing with me is ICT. Right? No one else. Pick ICT. You've picked me. Submit to your choice. Submit to the teacher. Submit to the knowledge. Absorb the knowledge. And you will reap what you sow. Those are all the points I wanted to make. The syllabus will be uploaded right now. And one last thing. I'd like to give you the names of the chapters right now. And write them down. Chapter 1. Anticipation versus outcome. Chapter 2. Importance of time in trading. What is time? Chapter 3. What is a time-based model and its components? Chapter 4. In-depth example of one of my favorite time-based models. Chapter 5. How to trade time-based models. Chapter 6. Purely time-based models. Only time, not price. Chapter 7. Time-based models, intricacies, and turtle soup details. Chapter 8. Why most traders fail. And on that note, I wish you good luck and a good trading. And pay attention. We are still in the beginning of 2024. You have the whole year to go. So no matter how much you fucked up in the past 3 weeks, and excuse my language, but no matter how bad you messed up the past 3 weeks, you still have a chance. Sharpen the blade and then use it. Good luck, good trading, and see you next week. All right, folks, welcome to Chapter 2. A lot of you are asking me, where's Chapter 1? And if you ask me that, then I'm truly disappointed in your question. Chapter 1 was last week when I said there's going to be a Chapter 1, and there was no Chapter 1. The lesson was anticipation versus outcome. What did you expect and what did you get? It was a metaphorical lesson. And it directly pertains to the importance of trading. Why? Because let's say you assumed and anticipated a key level to be hit at a certain time. You don't know what's going to happen. Is it going to hit? Is it going to dig deep? Is it going to go even deeper than you expected? Is it going to not touch the key level and give you a change in the state of delivery before? Your anticipation versus what happened is never guaranteed. And that was a lesson. That was Chapter 1. And today is Chapter 2, in which I speak about the importance of time in trading. The age-old question, time or price. Recently on Twitter, because Twitter is the biggest platform for trading, for some reason by default, there's been a hot debate going on between fairly inexperienced traders who are experiencing beginner's euphoria and challenging the more experienced traders about the importance of time versus price. I know a lot of traders personally, both in real life and online, I am connected with a plethora of important, experienced, and when I say experienced, I don't mean 2, 3, 6, 5, 6, 7 years. I mean decades upon decades, 20, 30, 40 years experience in the markets. And the common thing with all of them is they all agree to the importance of time over price. Whether it's time or it's timing, right? But time is always there for them before price. They always consider the time before they consider the price. That's an observation to be taken into consideration. You either know that time is more important than price, or you are simply uninformed. Now, what is meant by time? I'm going to cover 3 things: the importance of time in trading, the divisions of time, and why should we care about time? Why should you, the person watching, why should you care about the element of time in the charts? All right, folks, we begin with the importance of time. Why is time important? And to demonstrate, I usually have an example I give, which I will give again right now. This is the Euro USD weekly chart. We have candles, data, we have the price levels, and we have the time levels, right? So I have marked here the price 1.05625. Right? Now in June 2022, in the bear market, Ibrahim bought euro over here. He deposited into his offshore broker, 1 to 2,000 leverage, and he bought euro over here. What happened was it declined almost 1,000 pips and more. 1 year later, Barbara, who followed the right people and had the right information, bought euro over here at this time and this price. She bought at the same price level Ibrahim bought. Right? So understand that. Ibrahim bought at the same time, at the same price, Ibrahim bought at 1.05625, and Barbara also bought at 1.05625. Ibrahim suffered a 1,000 pip loss, and Barbara suffered a multiple hundred pip gain. What is the difference? Same price level, but a different time. The price of entry did not matter as much as the time of entry did. Barbara timed her entry properly. Ibrahim didn't. Another example. This is a daily candle. Which means these are hourly candles, right? Or 90-minute candles, if I'm not mistaken. Peter bought over here at this price level. You see this horizontal line? Peter bought over here, and from his time of entry, he was in profit. Adam bought at the same price level that Peter did, and he suffered loss. So Peter bought at the same price that Adam did. However, Peter made money and Adam lost money. What's the difference between the two? The difference is Peter was aware of the importance of time, and Adam was not aware of the importance of time. And for the astute observer, you will note the gray shaded area as a range being broken and retested. Open, high of the day in London, market structure shift, and then a continuation, a typical New York OTE. That's one point. The next point is the divisions of time. The trading community, especially the ICT trading community, really show their age and experience with their comments. It's not all about your 15-second order block. It's not all about weekly profiles. There's many ways to skin the cat. And the more you learn, the more you realize there is to learn. There's a verse in the Quran which says, "And you have not been given of knowledge except very little." Right? Which means everything everyone in the world knows is not even a drop in the sea of knowledge. So this is a mid-video reminder to remain humble and open, because that is the way to learn. If you're not, you simply won't advance, and we all want to advance. So, the divisions of time. First of all, you have the open, high, low, and close, which I would say constitutes around 70% of the importance of time. Then you have data ranges, the so-called IPTA data ranges, which were not pioneered and created by ICT. They were first discussed, to my knowledge, by Gann, by William Gann. He has a very similar concept to what is in the core content in month 5 regarding the trend changing every 19, 36, 54 days, right? 20, 40, 60, something similar along those lines. So understand that there is nothing new. And once you learn the history of the markets and the history of technical analysis, then you realize that there really is nothing new. And as long as you can find one thing which suits you, then you don't need to learn anymore. And that is the objective of this teaching, is to give you the tools for you to build your own model, right? Then you have time cycles, and then you have squares of time and price. So these are the 4 divisions of time. In this teaching, I will focus on the open, high, low, and close, because it shapes up the most and the bulk of the meaning of time. Data ranges are also important. What are the data ranges? I'm not going to go in depth over here, but in summary, they are specific points in time at which you look for a retracement or a reversal. And you can also use them to target liquidity pools. The data ranges they're a very powerful tool to blend time with the aspect of liquidity pools, right? Because that is all there is to it. Forget everything you see on Twitter. Forget all those charts with 10,000 different colors. Forget everything you see. 99% of what you see online is noise. To filter through the noise, there's 2 things: time and liquidity pools. That's it. And I don't care who says otherwise. I've seen enough to realize, and enough has been told to me to understand and know for a fact that time and liquidity pools are all that matters in the markets. Time cycles and squares of time and price, which are dates or even times which you derive at which a trend reversal will occur. Perhaps if there is a chance, I will talk about everything. I will reveal all I know, almost, because it's always impossible. I will reveal more about all 4 aspects in the future, if I see enough interest and if I see a benefit. There is a benefit, but this is the cake. And these are cherries. This is a big cherry, right? So in the future, if I decide to reveal more about these two, then you'll know. Anyway, so those are 2 points cut off. And finally, why should we care about time? Why should you, the person watching this, why should you give a damn about the element of time in the charts? Why not just go and pattern trade? Right? It's too much work anyway. Time and all this complicated nonsense. It's not. You should care about time because it is how smart money operates. At the highest level, the quarterly shifts, right, are a good example of the market makers generating interest in the markets for a specific period of time, going against that sentiment at a specific date, and give or take a few days, and maintaining a program, a trend, for a certain period of time, right? Why? Because smart money operates by quarters. Every turning point in the market is timed and predetermined beforehand. Every high and low, every weekly high is predetermined before the weekly candle even opens. Before the daily candle prints, the high and the low are already determined. Today's Saturday. Today's Saturday, the 27th of January, 2024. The markets are going to open tomorrow. The weekly candle. Next week's candle, which hasn't even printed yet, has a predetermined high and low already. Right? Because the markets are 100% controlled. All entry patterns, and back to point one, there is more I can say about it, but understand that every high and low is predetermined before it's made. Every swing point is predetermined. Every market structure shift is predetermined. Every order block is predetermined. Before the daily candle prints, I already see it in my mind. I see each hourly candle numbered, and I see what's going to happen before it happens. The only reason I can, because I know and I've been informed that the candles high and low, the level at which they happen is predetermined. All of them. Second of all entry patterns are subject to time. A quick glance at the history of the charts will reveal the importance of time. As we know, the history of the charts is a gold mine, and history repeats itself for those with eyes to see. Number 3, to trade without time, or without some knowledge of time, is to trade blind. Another thing is, you can deny it all you like, which happens on Twitter. I've seen new traders, relatively new, couple of months, couple of years, new traders denying the importance of price. And to them, if you are one of them in this group, or you're skeptical, it's either you completely deny it wholeheartedly, or you're simply critical. And I appreciate the critical thinkers within you who bring up criticism to me. Criticism makes the leader also grow better, so I appreciate you for that. However, I don't care who has what to say about this topic. About this topic, time and price, there is not a single doubt in my mind that time is more important than price. You can deny it all you like, you can run all you like, but you will always come back and submit to time before succeeding. It is the inevitable checkpoint before achieving consistent profitability. The example I gave you before about the most experienced traders I know and I'm connected to, they all unanimously agree on the importance of time. And I know I rant a lot about time and time and time, but once you reach a certain level of understanding and once you're shown certain things, then you have a conviction. I don't care who says what. It's never going to change. You'll never see me come back afterwards, change my mind, saying, you know what, guys, it was a prank. Price. No. Time. Any win you or anyone achieves without knowledge of time is pure gambler's luck. And it was subject to time, and I have more on this in the upcoming chapters. For now, that concludes chapter 2. I wish you good luck and good trading, and see you in chapter 3. Alright folks, welcome to chapter 3. In chapter 2, I realized the mic is kind of weird. Let's hope that is fixed in this one. Give me feedback in the chat. And for those who haven't joined the chat, I sent the link for a couple of hours and I deleted it. I will resend it right now in the private group. Join, and I will remove it again because I didn't want to, and I'm still considering removing it if I see misuse. All right, so you don't need the chat, and I don't recommend the chat to you if you are easily distracted. But if you want to, then I'll post it for a couple hours. Chapter 3, time-based models, an introduction. In this lecture, I'll be covering 2 things. What is a time-based model, and what are the components of building a time-based model? Number 1, which is what is a time-based model? It is a model which depends first on a time window, a specific time window to operate within, then on reading price within that time window. So you're basically mastering one specific predetermined period of time. This can apply to a specific monthly candle of the year, a specific weekly candle of the month, a specific daily candle of the week, a specific hourly candle of the day, etc. It can be applied to a specific season of the year. It can be applied to a specific data range of a couple of months within the year, and so on. To master a time-based model is to pick one of the aforementioned scenarios, one of these 4, or the ones I mentioned which are not written, and master them with perfection, hitting the model and building it from all angles. Some of you have more time to spare for the charts. You're either a student in a useless degree, some art, something, gender studies, or you have no job, or you have a job which gives you more time. To those people who are not like me, I'm a extremely busy person. As you know, I'm a medical professional. I have my family, I have my other businesses. So I don't have enough time, or as much time as some other people do. For those who do have the time, trading every single trading session is also a time-based model. Any trading Any trading is time-based trading as long as there's a moving chart which is not frozen because it's the weekend or holiday, then you are trading a time-based chart, whether you know it or you don't. So it's better to be informed because it's going to happen regardless. This is a look at the daily candle beyond the so-called kill zones. The daily candle has 6 4-hour candles, hence the importance of the numbers 159, 159. And this is something I've hinted at before and I've spoken about in the previous private group, which was level 2, Time and Turtle Soup, which you can find on the website. Link in the Twitter bio. I would really recommend that for those who want a full understanding, including this one. Now the plug aside, 159, 159 is what shapes the daily candle. Once you realize this, you realize that kill zones are customizable, right? You can curate your own kill zones once you understand this image. As soon as you understand what this means, then you've already made progress, and a lot of progress, in understanding the open, high, low, and close. More than the average Twitter follower or even some of the public group members. Most of them, you've advanced over them as soon as you understand this image. So there is some progress simply by looking at this. Simply by knowing this information, you have an edge. How you use it is what will transform this into money. Because that is why we're all in the markets, isn't it? Of course, in this teaching, I'm solely talking about demo money for legal purposes. A favorite non-conventional kill zone of mine is the 5 p.m. Yes, the 5 p.m. New York time. And I will leave that for your studies. There are 10 very high quality day trades per week. That is 2 per day, 5 days a week. These are the ones I'm mostly entering, and if you reverse engineer my entries, which some of you have successfully, and I congratulate you. If you are my mentee and you're spending time reverse engineering all my turtle soups, then you already have advanced over 90% of the followers and members. Which there are 25 good quality day trades per week. 159, 15. I'm hesitant to say 9 p.m. because it's usually consolidation, right? As we know, the markets spend 70% of the time in a consolidation and 30% of the time is not. So this gives you an encapsulation of the data, right? This is a form of collecting data. You know exactly when you're going to trade, which is twice a day, 1 and 9. If you have more time, then you can go and trade every single 4-hour candle. Likewise, there are 2 very high quality short-term trades per week. Once at the low of the week, once at the high of the week. As a general rule of thumb, the low of the week will form Monday, Tuesday, Wednesday. That's trade number 1. And the opposing end of the weekly range will be capped on Thursday, Friday. Trade number 2. With this information and this image, you can think outside the box and create your own weekly profiles. For example, Monday low of the week profile. This image is not random. For the astute observer, you will realize that this is a chart of Euro USD a couple of weeks ago. And I had come here on Twitter and said, I'm scooping up some Euro. All right, that was a Monday low of the week. And it never saw a decline after that. Why? That's your homework. Think, when does the high of the week form on Monday instead of Wednesday, instead of Tuesday, for example? But to encapsulate the weekly candle, you can be sure that it's going to be made, the low of the week is going to be made on Monday, Tuesday, or Wednesday. And the range will be capped on Thursday or Friday. And another thing is, the same candle, for example, let's take Wednesday. Wednesday cannot form the high and the low of the week. And that is my encouragement for you to think outside the box. Don't just look at this information and memorize it. Dissect it. Each word. Nothing is random. Nothing is placed randomly. Everything is deliberate. Once you understand that every day is a new opportunity, when I say day, I mean true day, which is the New York time, then FOMO ceases to exist. Because every midnight New York time is the birth of a new opportunity. Apply this concept with the fractal nature of time and price in mind to watch your win rate skyrocket. Truly, because if you missed a move, then you can simply align yourself with the next midnight New York time and watch a sense of calm take over your trading career. Why? Because every single setup you will take is timed beforehand. And this is one way of doing it. Once you truly digest this information, you will view trade setups as buses. If you miss one or you miscalculate one, then simply wait for the next. A common mistake is revenge trading because you missed one. Or FOMO. There is no FOMO. 159 will never change. So you have no excuse and no reason to FOMO. To relax, mark your levels, get a cup of coffee. If it hits the level, fine. If it doesn't, study why. Catch you next time. Understanding the bus stop analogy is your edge against uninformed dumb money. I'm pretty sure most of you, this is the first time thinking of price in this way, as every midnight is a new opportunity, either for reversal or continuation or a scalp or whatever. Midnight New York is your key. And every midnight is a new opportunity. Every 159 is a new opportunity. And this includes ICT students who trade patterns, which is pretty much every single one on Twitter. That's one point. The other point is, what are the components that help build a time-based model? Your progress, you, the person listening right now, your progress is going to be divided, and it's going to happen in 2 stages. And most people never make it past stage 1. Or they reach stage 2 and they get lazy, complacent, and they hop on to the next strategy. And that is not my goal with this group. My goal is not to have a bunch of strategy hoppers who came here because of the hype. Nope. Of course, I can't force you, but I can remind you, I can gently push you in the right direction. I can help you walk. I can hold your hand. I can walk slowly with you. But eventually, you're going to have to do something by yourself. You're going to have to, for improvement to happen, there has to be a will. Both a will to improve and a will to take action. Stage 1 is picking a specific time frame, and then picking a specific time of the time frame selected. Time of day, day of week, week of month, specific weeks, specific hours, specific days, etc. And then getting 2 sets of data. Back-tested data of at least 1 year, ideally 5 to 10 years, the more the merrier. I have some concepts, and this is an important part of understanding your edge, is crunching the numbers. I have some numbers crunched back 40, 50 years, even more. So when I see someone being too lazy to even back this to 1 year, it's astonishing to me. And successfully forward tested data of at least 3 to 6 months. And this is where the importance of lower time frame practice comes in mind. And this is the data, the forward testing, which will ready you for live market conditions. Once you obtain the aforementioned sets of data, stage 1 is complete. And you move on to stage 2, which is forward testing the model you have for 3 to 6 months. And once you find favorable results, you are 50% done. This should be 49, because the remaining 51% depends on you, the trader. A lot of you will watch this, and I know a lot of you will gloss over this part, but it is the most important part. Everyone has information. If you want information, information is ready and available for you, both free and paid. If you paid and you're inside here, then you're trying to get better information. But there is free information, right? So there is no lack of information. If there is no lack of information, then why are 95% losing? The answer is because the edge is in the trader, not in the strategy. You are the edge. If you have the wisdom to select the correct mentor, that's an edge. If you have the wisdom to stick to him, regardless of his tone, because a lot of gifted people, they are usually hard to deal with, I've noticed. Including ICT, for example. Let's take him as an example. He's very, he rants a lot, right? Something I might not have taken from him. But if you can pick a successful mentor and try and emulate them, then you're better off than 95% of traders, because what they do is go from one mentor to another mentor to one strategy to another strategy. If you can dig your heels in the sand and really refine and force improvement, then there is no other way but improvement. You are the edge, but only if you choose to be. And that concludes chapter number 3. I wish you good luck, good studying, good trading, and see you in the next one. All right, folks, now we have chapter 4 and 5 in one, because they're linked closely. So I did say I'll upload 5, 6, 7, 8 tomorrow, but it's going to be 2, 3, 4, and 5 today, and then 6, 7, 8 tomorrow. Now this chapter is going to talk about an example of a time-based model and how to trade it. It's an example. You don't have to stick to this one. You can if you want to, but it's showing you how to build and how to trade one. If you so choose, of course. The model is Wednesday model. And it depends on the daily and weekly candles. The weekly and daily charts are gold mines for those with a shovel, and a good one. The better quality your shovel is, the more money you will make with these two charts. We have here Euro, the weekly chart, which I called for you on Twitter. And in it, we'll see an important phenomenon, which is there's an 81% chance that the high or low of the weekly candle forms between the Sunday open and the Tuesday London session. And there's a 70% chance of Tuesday printing the high/low of the week. This is a concept discussed by many great minds in the realm of technical analysis. One of them, most notably, is William Gann. And of course, not a surprise, but also ICT mentions this in his teachings, which is true. Tuesday has a high chance to print the high of the week. And to make things even more focused, because I'm reminded of the quote, and this quote keeps popping up in my head the more I used to study the charts. Then I always had this in mind as I was learning, which is the quote of Arthur Conan Doyle. In the book Sherlock Holmes, where he says, once you eliminate the impossible, whatever remains, no matter how improbable, is the truth. Right? So once you eliminate the impossible, whatever remains, no matter how improbable, must be the truth. And that was an inspiration for one of my famous diagrams, which have circulated the internet, of the possible shapes of the daily candle, which I will link in the group. So as you can see, this is a beautiful example of a classic by week. There's many different ways the weekly candle can print, and you can trade them all. You can trade all of them. I can trade all of them. Anyone can trade whatever he wants. However, if you put all your energy, which you're wasting trading ranges, and I mean ranges when there is a chance of an expansion. Ranging markets are my favorite, but if there is a chance of an expansion and you only trade the range, then you're missing out. Right? So this shape, open, buy below the open, and then hold till the close. You don't close when it reaches this high. You close on Thursday. Right? So I'm entering on certain days and exiting on certain days, which will cap the range. You understand? In this case, I had alerted you, pretty much free money, if you're focused, that this is the low of the week on Euro. Monday, Tuesday, Wednesday mark the low of the week, and Thursday, Friday mark the opposing end of the range. Now, taking into consideration the two previous data points, This means that there's a high chance that Wednesday will print a classic buy/sell candle in the weekly and daily order flows direction. It's not a guarantee. And when I say buy and sell candle loosely, right? Because for me, as long as I can buy below the open and sell at the open, that is a success. As opposed to pattern trading the power of three. That is another mistake, right? So you'll trade the pattern. I'm trading the logic of open, low, high, and close. If you looked for trades which go from the protraction, the Judas swing, back to the open, and that was enough, that was all you did for the day, then you would find a lot more trades and you would be a lot more successful in catching trades. And in this instance, I'm reminded of another quote, which is, have an opinion on what the market should do, but don't decide what the market will do. Be happy with a percentage of the move. Variations depend on what day the PDRA is hit, which creates the weekly low. This is a rough depiction of the Wednesday model. Opening time, rise key level down to the opening price. All right, so the 1 o'clock candle creates the high of the day, and the 9 o'clock candle gives the retracement, protraction, and expansion. Price leg distribution number 1, protraction distribution number 2. Right? That in itself was a model just now. A more detailed look would be open, we rally, we are bullish on the higher time frame, right? Because you always have to pair one time frame with the other one. So we're bullish on the higher time frame. Opening price, rally. Fake out of the pattern Judas swing traders. Range, so rally, range, turtle soup at a key level, turtle soup, breakdown. Now there's a change in the state of delivery on the higher time frame, which is a market structure shift on the lower time frame, right? An order block on a higher time frame is a breaker on the lower time frame, and a breaker signifies a market structure shift. That all comes second to the time all this is happening, right? Open, London, high of the day, New York OTE, and we go down. Here's a real life chart example of the Wednesday model. You have open. This is, of course, the 5 p.m. open, right? So if you want the midnight New York open, it's going to be around here. Right, so open, decline, hit the key level, the previous low, retest the body of the previous low, right? Range low, range high, range low, retest the body of the previous low, and rally. On the higher time frame, you'd find a PDRA, which stopped this rally, this decline, excuse me. So open, decline, range low, change in the state of delivery, shift in the market profile, not a pattern, shift in the market profile. So we go from breaking lows and rejecting highs to finally breaking this swing high. As soon as we break the swing high, then we can start looking for a deep retracement, which will scare off anyone who bought up here and scare off anyone who's looking to buy, right? Because down here, you had dumb money selling. When you rallied, you had dumb money buying. And the market's function is to trip and offset as many positions as they can. Right? So someone, hopefully none of you, someone sold down here and bought up here and sold down here again because of decline, right? Pattern FAG, pattern trader. And those people are the liquidity which we rely on. And it is the logic I always have in mind. I never think what happened. I think, why did this happen? Right? As I'm living this candle alive, someone sold down here. Someone sold down here. Someone bought up here. Of course someone did. It's an old high, right? Range high. And beautiful range low to range high. Never changes. So back to Wednesday model. That is a price observation rant. I'll leave the details for the next chapter. Open, decline, create a range, turtle soup, break out of the range, and then rally. Another example of the Wednesday model over here. You have Wednesday. Open, range, when the time is right, turtle soup, change in the state of delivery, and a shift in market structure. The market profile has changed. We went from breaking lows to breaking highs. So now it's bullish. It's not a pattern. It's showing that smart money is no longer willing to sponsor the shorts, right? As soon as you break above this high, you're bullish. Yes, but we wicked down here. Yes, but if you remove the wicks, you'll notice that we never closed a body below this low. Wicks do the damage, and bodies tell the story. And you'll notice this a lot about FVGs and order blocks. In fact, this is a good homework, which is go back and remove the wicks and see what you get. So open, range, turtle soup at 3 o'clock, right? Because we know that there's a recurring 2 a.m. model every day. And if 2 a.m. is a manipulation, then the manipulation is leading to a swing low at 3, right? 3 a.m. is an important time for turtle soup, which no one mentioned until I did, and then some people have recently started mentioning it, but nobody was aware of that time before I mentioned it. So it's good to finally see it going mainstream. 3 a.m. is an important time to look for turtle soup. Next up, you had the OTE continuation, right? So you have accumulation, manipulation, distribution, consolidation, expansion, retracement, smacking back into this range, and expansion again. These PD arrays, this inverse order block, these are all confluence levels with the consolidation. I don't care about them. They come secondary, but the consolidation, expansion, retracement, expansion is what matters more to me. Next up, how would one go about trading this model or any time-based model? Of course, with a demo money, if you so wished. Because that's another important observation, which is teaching analysis versus teaching execution. In this one, I'm teaching you analysis. Execution is a topic for later. Number 1, or step 1, determine higher time frame directional bias and narrative. Bias is where and narrative is why. 2, mark out the midnight opening price before opening time before midnight arrives. Mark a potential key level, which will mark the high/low of the candle you are willing to trade. Mark a liquidity pool. More on this in the upcoming chapters. Mark the CBDR/Asian range /flout standard deviations to approximate an area of the low of the candle or high of the candle to happen. Standard deviations are a good tool, but they are not. Again, they're all subservient to the element of time and the higher time frame key level, which always has a liquidity pool paired with it, right? Wait for your pattern, and you see when the pattern happens. It's not look for an order block. It's look for all of this and then an order block. It might seem like much to do at the beginning, but it becomes second nature. It's like driving, right? At first you're looking at the mirror, the side mirrors, and the rear view mirror. You can't talk while driving, right? At the beginning, but eventually it becomes second nature. All of that. And for those who drive a manual, which is more fun, you will also understand the learning curve of anything, of any skill. Number 5 is wait for your pattern to form below the opening price after the protraction has happened. Number 6 is memorize and write down your observations. If you're right, note and repeat. If you're wrong, note and avoid. And if you miss, note and catch it next time. That is the importance of a journal. It's not some diary, right? And I don't journal much outside of my patients and my trades. I think it's a waste of time. But in trading, it is an absolute must. So that's the idea, is opening time, key level marked out beforehand over here, protraction, expansion number 1 happening at this time, OTE, and then expansion number 2. The OTE means that a swing high will form, a predetermined swing high will form within the daily candle, smacking into the 1 hour candle, the 1 o'clock candle, excuse me. Right? This right here is the highest. If it's confirmed up here, then this is the highest probability trade you will take, even higher than this, because if there's one expansion leg, then it's very likely that you have another expansion leg due. If you have an expansion leg that broke market structure and shifted it, right? You see a high, low, higher high, and you break the low that broke the high with a massive swing, and there's a high chance there's another massive swing, at least the same size, which is due. Procedure to show you how it's visually done, and I've never spoon-fed this much in my life, but the procedure is as follows. Number 1. Step 1 is determining the higher time frame directional bias. Candle number 1, candle number 2. If candle number 2 has taken the low of candle number 1 and has not closed below it, then there's a high chance that it retraces to 50% of candle number 1 and 100% of candle number 1. So Monday, Tuesday, Wednesday. 3 candle model for those who have attended the previous one, time and turtle soup, level 2 on the website. Shameless plug, yes I know, but it's really important. That is one of the most important lectures I've produced ever. And I cannot recommend it enough. The stuff in that lecture is actually, there are some things in there which I never intended to release to the public, but I did anyway. And the fact that I'm even reminding you that it exists, I'm slightly hesitant. However, it is crucial, which is why I'm reminding you. If you haven't got level 2 and you can, then get level 2. It's on the website, link in the bio of Twitter. So candle number 1 is over here, Monday. Candle number 2, Tuesday. This gives me a directional bias for Wednesday. Pair with that the fact that Wednesday has a high chance of being a classic buy or sell candle in the direction of the weekly and daily order flow. This gives me an excellent opportunity for a potential trade. So you have Monday, you have Tuesday, and you have Wednesday. Before Wednesday opens, we keep in mind that every midnight is a new opportunity. We have it marked. We have this rejection block marked. If we have long wicks or even stubby wicks for the order block, then this is swing high. And swing highs are usually good stop losses. Therefore, we mark the rejection block. And of course, the 1 o'clock candle produces the low, and the 9 o'clock candle produces the OTE. Accumulation, manipulation, consolidation, expansion, leg number 1, retracement, expansion, leg number 2, the order block to the pip, the opening price. And I have something very important to speak about regarding opening prices and closing prices in the next chapter. Consolidation, expansion leg number 1, retracement, expansion leg number 2. A very, very high chance that there's another leg after the market structure shift. So low, high, swing low, break the swing high, that broke the swing low, that caused a turtle soup. This high that caused turtle soup is broken with a massive expansion wave. There's a high chance that there's another massive expansion wave due. Add to that the fact that this long-wicked candle was disrespected. This wick is going to be used as the mitigation level, which smart money will use to mitigate their positions. And yes, they mitigate the positions. Price doesn't mitigate anything. That's a pet peeve I have, which is when people say that price mitigates. It doesn't. Traders mitigate their positions. Price doesn't. Range theory commentary. When the daily high and low are formed, then on the 15-minute time frame, you will find a range being souped. All right, this is 3 o'clock. That's one thing to note right now. If you're getting lazy, then snap out of it and write down that in your notes, which is the daily candle, the high and the low will form with a 15-minute range being souped at the high or the low. Another thing is this Monday range. This is a classic Monday low to high model, right? That is by itself a time-based model, which is discussed in depth in level 2, the advanced version. The basic premise is Monday, Tuesday takes out the low of Monday, does not break below it. It's a false breakout, seen by the number of closes and the lack of intention, the support as an idea. Smart money is supporting this low. It's sponsoring this low. Therefore, we can safely assume that Wednesday will take out Monday's high. or even Thursday. If there's a news event which will restrict Wednesday, then Thursday will take out Monday's high. That is how you also extract a directional bias on one time frame. Pattern traders, they saw this market structure shift and they were buying all the way down. They got stopped out. And then market went to their objective. Right? So don't be a pattern trader. You see the difference. I'm not even looking at the pattern. I'm looking at the highs and lows, the market profile, and the ranges. The market profile broke the high. Okay, fantastic. But now we're rejecting this high and breaking this low. The profile on this time frame has changed. Right? If you can trade one time frame, although I always advise my mentees against it when they ask. You can, but you shouldn't. Right? But if you want to, at least do it right. Market profile, a high being broken, okay, we're bullish. However, now that idea is being negated by this rejected high. This rejected high gives you an insight into what smart money is doing. They are refusing to sponsor this high as a breakout. They're using this high to pair orders. Everyone's buying up here, right? OTE buyers all up here. And using that against them, it is confirmed when they break this low. The low that broke the high. Or even this one, right? You see lack of intention of smart money to sponsor the lows and an intention to falsely break above the highs. Market profiling. That is, in summary, market profiling. Checking the highs and lows to see what is smart money sponsoring and what is smart money using as a pivot point to false breakout. So yeah, this open range, pre-opening range, soup, breakout, leg number 1, expansion leg number 1, retracement, expansion leg number 2. It's that simple. Consolidation, expansion, retracement, expansion. Leg number 1, leg number 2. Wednesday, classic buy day, right? That's the end of it. If you focused on catching 4 of these per month, instead of trading every single 1 hour candle you see, then you would have a much more successful career as a trader. That concludes chapter number 4 and 5. I hope you found it insightful. It was packed. And I wish you good luck and good trading, and see you in the next one. All right, folks, welcome to the final chapter, chapter 8. This is the most important chapter along with chapter 1. Why do 95% of market participants fail? I suspect a lot of you will find delight in chapter 7 more than 8 or the other ones, because chapter 7 is indeed filled and packed with information. However, this is more important than any technical analysis I can teach you. In trading, especially, and in life generally, when you study how to not do the wrong thing, then by default, you'll do the right thing. When you study your losses and dissect them, why they happened, and understand the losses and vow not to repeat them knowingly, then the only outcome can be success and profit. Because if you're not losing, you're winning. Right? So if you eliminate the loss, then win is the only other destination. It's the only other fate. So, we commence now, chapter 8. Why do 95% of market participants fail? The short answer is because they quit when they should be persisting. Where there's a will, there's a way. You heard that one before? It's an old saying. And it's true. Cliches and proverbs are cliches and proverbs for a reason, because they have stood the test of time. There's going to be some of you who will simply coast by this mentorship and move on as if nothing happened. I know that there's going to be a lot of you who will completely transform their trading, as has happened before with the previous ones. But there's going to be some of you who coast by this one, and this message is for them. Snap out of it. Focus. Excuse me, that was the car. Snap out of it, focus, and get professional. We just started the year. Q1 is almost over. And this was recorded before, actually, but I had to redo it right now. Q1 is almost over. And it's a long year ahead of us. And I've given you enough tools, a lot of tools, enough tools to completely milk the year, if you can focus. So I've done my part. My part is showing you the way. My part is pointing you to the road, and your part is walking to it and taking the path that it leads you to. I can't emphasize enough on how important it is to avoid multiple sources of information, focus on one or two max sources which are in alignment, and get to your charts. You will learn the most spending time by yourself in your room or basement or desk or wherever you are, wherever you like to go and practice. But you will learn the most studying by yourself. It's good to have groups. I was at one point 100% against them. I still am. But I understand the importance of having multiple eyes, for example, when it comes to gathering data, when it comes to forecasting. A might see what B missed, or what C didn't have a clue existed, right? So there's power in unity, that's for certain. But when it comes to honing your craft, when it comes to sharpening your blade, then the most you learn is by yourself, alone, in a room, curled up, looking at the screen, and dissecting each and every candle on the charts, right? So that was a mini introduction speech, and now we delve into the technicals of why a trader fails. Here's a cycle of a failed trader. Step 1, discovers a potential strategy. And this could be many of you. If this is you, pay attention. And the first step to curing a disease is diagnosing a disease. Right, as a doctor, before curing, I have to diagnose. I have to see what's the anamnesis, the medical history. I have to see what's wrong. So if you don't know something's wrong, you can't improve. You first have to admit there's something wrong, and from that moment onwards, improvement may happen. A failed trader discovers a potential strategy. Excuse me. He then takes a strategy, for example, a golden zone fib. He backtests the strategy with a beautiful result of a 100% win rate, as goes with backtesting. And a little side note, when I see these absolute goofballs on Twitter sharing the data like they did something, my backtesting strategy yielded me 80% win rate over the 3000 R. It's irrelevant. Backtesting is a tool. It's a means to an end. It's not the end goal. All right? It's important, but more important more important than backtesting will always be tape reading and live trading, right? Forecasting beforehand, noting down what happened. So backtesting has its place and it has its importance, but don't let it overshadow, as many do, the importance of live market forecasting and tape reading and actually trading live funds, if you so wish. So, he discovers a strategy. He backtests the strategy with a result of 100% win rate. He then tries the strategy in live, in live market conditions. And of course, he fails. He then goes on to abandon the strategy. And if it sounds familiar, this is okay. This is okay. This is normal. But if you reach this stage of the cycle, then you've failed, which is abandoning the strategy because it didn't work, which is what most people do. And you want to have a minority mindset because the minority win, right? So this is what the majority do. Strategy, backtest, try, fail, fuck it, abandon, next. It's a never-ending cycle. And a successful trader cuts the cycle off where he should. A successful trader, this could be you. It could be you right now. I have some killers in this group who joined just to sharpen the blade even more. Right? So if you've succeeded, this is what happened. If you are yet to succeed, then this should be what should happen. You discover a strategy, a turtle soup, which is the only strategy which matters, the market mechanics in the flesh. You backtest the strategy with the results of 100% win rate, of course. You then try it in live market conditions, and this is what differentiates the successful trader from the failed gambler, which is when a successful or to-be successful trader tries in live market conditions and fails, he then questions why. He blames himself, not the mentor, not the strategy. He asks himself, why is this happening? Why did I fail? Why did I mark this gap and it disrespected it? Why did I mark this market structure shift and it just went and stopped me out? Why? What did I do wrong? Because the market is perfect. The system is perfect. The system is perfect. So stop blaming the system. Time and price will always be in alignment with higher time frame order flow. Always. This will never change. The open in a bearish day will always go up for London and break down, and then the shift in London is the trend for New York. That's always going to happen, right? Low, high, lower, low. Expansion leg, higher, high. Leg number 2 is always going to happen. What's not going to be so consistent is your emotions, which is normal. You're a human being, after all. You're not an algorithm, right? So understand that first. The first step is understanding that the system is perfect. You are at fault. It's always the operator's error. Same in medicine. You learn the importance of being the operator and realizing that most mistakes that happen in surgeries, for example, they happen from the lack of experience of the operator or the mistake committed by the operator. Operator error is what accounts for the majority of malpractices in the world, in all clinics, in all hospitals, right? So the system is perfect. Stop blaming it, blame yourself. Stop randomly pressing the buttons for the sake of pressing it, which I know all of us have done. Yes, even me, once upon a time. But some of you, you've made it part of the routine, right? For your trading routine, wake up, press buttons, go to sleep. Stop it. Organize your personal life, because it does infiltrate into your trading. Plan the trades, and thankfully we have an edge. If you're in this group and you've watched the previous chapters, then you have an edge, which is you know that your setups are timed, so you have everything planned beforehand. The only way you can fuck it up now is by not understanding the higher time frame, or not getting the correct higher time frame directional bias, and that's one important thing, and lacking chart time. I've given you the sword, I've given you the weapon, I've given you the tool. Now and I've shown you how to use it. If you're going to actually use it, that's up to you. Clean your room. And I don't say this frivolously or as a joke. I say it seriously, because the state of your room tells me the state of your mind. If your room's a mess, then you probably have 200 tabs in the background of your phone, right? So clean your room, if you have a room. Clean your house. Organize your day. Have some sense of time management. And this drags me back to the previous point of minority mindset. The majority of people don't clean their room, and they have unorganized lives, and they lack time management skills. And of course, the majority always lose in the markets. So that is something to take into consideration. It's not a direct cause, but me, for example, I find when my room is clean and not messy, then I can trade with a clear mind. I'm a Muslim, so when for example, I pray 5 times a day. As a Muslim, you have to pray 5 times a day. So when I pray them on time, then my mind is a lot fresher, as opposed to when I delay one, which should never happen, right? So manage your time. Next up is an image of the stages of the ideal trade. Planning, marking the key level, waiting for the level to hit, executing, and waiting. As you can see, waiting constitutes of 50%, more than 50% of the time spent framing a trade. Right? Planning is also a large portion. Executing is a couple of seconds. Enter, press the button, exit the application or the website. All right, so waiting, patience. Chapter 1, which many failed. Patience, patience, patience. Everything is not as it seems to be at first glance. Never judge a book by its cover. Always think at a deeper level. And of course, the mistakes the neophyte will commit in each stage, I'll leave them for you to read. And finally, do you need a trading journal? I always bring up the example of myself, but every profession in life has some sort of a register. Even down to the cashier, for example. He goes and he prints you, they go and they print you gotta be PC these days. They go and they print you the receipt, right? So a register of some form is important if you want to be a professional. And every single professional trader I have ever known, and the best of them, and I've known many, I'm connected to many of them, multi-million dollar traders. Yes, some of them with hedge funds, some of them manage investor capital, but every single one of them has a professional journal. And I've spoken about journaling a lot. You can go to Twitter and search journaling, etc., and you'll see, right? So that concludes this teaching. I don't want to drag it out. You already have chapter 7 to deal with. And I wish you good luck and good trading, and see you all. Alright folks, welcome to chapter 7. In this one, we'll be looking at intricacies and turtle soup details. The main topics will be: what are some price action details we should pay attention to when trading time-based models, turtle soup intricacies, and the bulk of the chapter is going to be addressing higher time frame order flow. Because without a good grip on the higher time frame order flow, your turtle soup will fail, because you'll be trading the distribution instead of the manipulation, thinking it's manipulation, right? Has that happened to you before? Is you think it's a turtle soup, you go on Twitter, you see me taking the turtle soup, you go into your own chart, you try and take a turtle soup, and you fail. It just keeps going higher. You open the chart, you go look at an old high, you randomly short, and you get liquidated. Does that sound familiar? And it probably does. The reason is because you weren't in alignment with the higher time frame order flow. And by higher, I mean relatively higher. All right, 1 hour bullish order flow will give you a 5-minute, 1-minute bullish turtle soup, right? And so on. So when I say higher time frame, I mean relatively higher to the time frame you're looking at right now. That's in specific, but in general, when someone is saying higher time frame, when you hear ICT or me or anyone saying higher time frame, then usually what is referred to is the weekly and monthly charts. They are where the bulk of the volume lies, and they are where smart money and the institutions go hunting. All right, so the biggest moves, logically, will come from the monthly and weekly charts. And speaking of time frames, there are some other ways to customize your time frame if you have TradingView Premium, and that can give you some insight into, for example, the weekly chart before it closes, right, with the 5-day chart. But that's a topic for later. All right. For now, we focus on these 3 points. For starters, you have this picture. This picture depicts a reality, which I will address in the next chapter in detail. But it's the truth. You saw me trade turtle soup. You tried 1 turtle soup, 2, 3, 4, and you quit midway. Here's one thing I'll tell you is, no matter what mentor you go to after me, if you do, I happen to have a quite high retention rate for students. But no matter what strategy you take, no matter what mentor you choose, which I don't recommend anyone except ICT. And if you resonate with turtle soup, then me. And maybe Kish for order blocks, right? But I don't recommend anyone. Why? Because if you have multiple sources of information telling you different things, then you'll be distracted. That's not a good learning environment. Have 1, 2 max sources of information which are in alignment, right? They complement each other. Otherwise, you're prone to committing this error, which is try one strategy and hop on to another one when it fails. There is a more in-depth discussion in the next chapter, but for this one, I will stop there. The learning curve of price action is 4 steps. No matter who you are in the entire world, from the moment you enter the market, from the very moment you sign up to MT4 or whatever broker you have, and from the moment you choose this path as a trader, of course, some sign up before choosing the path. From the moment you choose to be a trader, there's 4 steps you'll go through. Step 1 is receiving the information, and this learning curve is referring to the learning curve of analysis, right? And then it transitions into execution. Step 1, receiving the information. So I'll tell you this stuff I've told you in chapter 1, 2, 3, 4, 5, 6, 7, 8. 6 is cancelled. Step 1 is receiving the information. And some of you were asking me why I canceled it, because the information in chapter 6 is not something I find appropriate to share right now. Because obviously I can't give you everything at once. That is just counterproductive to you. All right, so chapter 6 had some information in it, which I can't say much, but the information in chapter 6 is not at the level that you are studying right now. And I know there's some pretty advanced students in here who might have got their ego hurt by that, but it's the truth. And for those who are observant and astute and have a good memory, remind me of chapter 6 later on. Anyway, back to the presentation. The learning curve, step 1, receiving the information. Step 2, witnessing it work. Step 3, trading what you witnessed work. Step 4 is fixing the execution mistakes. Because forget profiting for a second. If you focused more on correcting the losses, then the only result is a profit, right? So put more emphasis on correcting mistakes rather than trying to discover the Holy Grail, all right? If you correct your mistakes, and people have this innate narcissism inside of them, even if they have not earned it, which is the market is wrong. No, it's not wrong. You're wrong. So fix the mistakes you make when executing. Now to the charts. That little mini introduction / rant over. Price action details. When you open any chart, knowing what should happen is the first step. Bias and narrative. Bias is where, narrative is why and how. What does the process of anticipation look like? Something very little spoken about. Right? They all tell you FVG, order block, supply and demand, volume profile, Elliott wave, harmonics. They tell you how it works, but they don't tell you what you should be doing in the process of anticipation. That will be looked at over here. And what signatures will price demonstrate at the times of creating the low or the high of the candle. Very important. So for your sake, I hope you are taking notes. One of you DM'd me, he showed me that he was taking notes even on my rants. You can do that. I do slip some information mid-rant, so if you are persistent enough to listen, then you have caught them. Anyway, higher time frame directional bias. How does one go about determining the higher time frame bias? Because as we know, it is a critical element of a successful turtle soup consistent trader is correct identification of the higher time frame directional bias. And this is something I introduced to Twitter last year. Before I came on Twitter last year, I noticed that everyone, with very little exception, were trading market structure shifts and breakers and order blocks. Right? Even order blocks, not that many. But they all waited for the market structure shift and the OTE and the FVG. Those were the hot ones. Nobody paid attention to one of the most key elements, and I find that ironic, which is the higher time frame, the higher time frame directional bias. Now, of course, 1 year later, as you can see, the effect is palpable. The higher time frame bias has become the norm. Yet they still don't know all the details. And I will gloss over some in this one. So, how does one go about determining the higher time frame bias? Highs, lows, FVGs, opens, and closes. And before we continue, I'd like to tell something to those of you who don't like the rants. It's understandable, right? But if you can't stand the rants, then you don't deserve the knowledge that comes with the rants or before and after the rants. Ask questions when determining a higher time frame directional bias. Ask questions such as, what is a safe low as a stop loss? What is a conservative target? What opening price are we respecting or disrespecting? What PD arrays are we respecting / disrespecting? What breakers are we respecting or disrespecting? What are the odds a gap doesn't get filled? Because as you may, if you've been trading ICT for more than 3-4 months, then you know that sometimes you mark an FVG and the FVG doesn't work, right? Why does that happen? Why? Are they using down close candles for support? Or are they using up close candles to sell? As we know, smart money buys in down close candles during a bullish or a buy program, and they sell in up close candles when they're bearish. When you ask these questions to yourself, then ask yourself also why. What is a safe low as a stop loss? The low that rebalanced in FVG. Why? What is a conservative target? Those equal highs. Why? Because they overlap with a higher time frame FVG, and a higher time frame FVG, which has equal highs on the low time frame, is a high quality target. That's an example. Market profiles, an important topic. The market makers, they don't move price in vertical lines, right? That's not wise. It's not possible, first of all, due to the amounts traded. And it's not the way the markets move, because if they did move that way, then you'd all make money. No one would ever lose. It's just going up or down. No. what happens is they go in consolidations and then trend, consolidation, trend, consolidation, trend, and every consolidation leads to an expansion. All of them, right? You will never find a market consolidating forever. And if you do find a market that is consolidating for a long time or for an extended period, and I say period relative to the time frame you're looking at, even the consolidation, this one over here, for example, has a trend within it, right? But generally speaking, money moves in consolidations and trends, right? That's how the markets are made. How to identify whether we're trending or ranging. There's multiple ways. The way I use is highs and lows, right? So are we rejecting lows and breaking highs, or are we breaking lows and rejecting highs, bearish? Or are we ranging, which is rejecting, showing lack of will to break out of the high, right? Showing the will to remain in this consolidation, respecting both highs and lows. It's a choppy market. You wait for a gap in one side before exiting the range, right? So when you're ranging, then you wait for a gap to form, and whichever side the gap forms, that is probably the side of the breakout when paired with a false breakout on one side, right? If you didn't catch the last part, then watch it again. Any given time frame, this is an important concept, so I want to give it its time, which is any given time frame is only bullish until it reaches a higher time frame key level. Any given time frame is only bearish until it reaches a higher time frame key level. And this one is a very important one. I've hinted at it publicly, but this slide you're watching right now, this slide is how you're going to trade and make money even when being wrong on the higher time frame. Pay close attention. If you're listening to it, come watch. Put everything down, take your cup of coffee, and watch closely. Any given time frame is only bullish until it reaches a higher time frame key level. Any given time frame is only bearish until it reaches a higher time frame key level. What does this mean? This means that gaps on the 5-minute time frame will only be respected till we reach a 15-minute key level. Order blocks, up close candles, or down close, on the 15-minute time frame will only be respected till we reach a 1-hour key level. A 1-hour key level. Highs and lows on the 1-hour time frame, we will only respect lows and break highs on the 1 hour until we reach a 4-hour key level. Excuse me. Inversely, a 4-hour key level will be disrespected if a monthly key level is being respected, because in trading, everything can be inverted. Order blocks, breakers, FVGs, even concepts. A famous saying of mine is, every exit is an entry and every entry is an exit. Right? And really ponder over that. Ponder over the fact that every entry of smart money is an exit of smart money, and every exit of smart money is an entry buy smart money. Here we have the lower time frame. We are respecting bearish PD arrays, correct? Bearish premium PD arrays. Premium and discount, it's a long topic. But in summary, don't buy a bullish FVG unless it's in discount. Don't sell a bearish FVG unless it's in premium. Eliminating the FVGs which are bullish, which are not in discount, will save you a lot of trouble. So now we're respecting this premium bearish PD array. However, we have reached at a discount of this leg, and this leg is more important than this leg because we have a low, we have a high, we have a lower low. Everyone's selling down here, right? And then we have an expansion wave. This is a pattern, but it's also a logic, right? The market makers, of course, when you see the higher time frame, you'll understand, but the market makers sunk price below this low to accumulate as many positions as they want, right? And they will distribute the positions they accumulated below the lows above the highs, one by one, 20, 40, 60. And the market profile tells me we're bullish. Why? Because low, high, lower low, higher high. Expansion wave, which tells me there's another expansion wave due when we reach this breaker. And this is a chart I've called live. It's not some hindsight cherry-picked nonsense. This is a chart I've called live on Twitter for everyone for free. And there was a lot of money which could have been made by this chart. But that alone is not enough. This breaker alone is not enough. If you go to the higher time frame, we're respecting this bearish weekly PD array, right? Sell, 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 all the way down. You look for weekly open, sell in the wick, down. Weekly open, sell in the wick, down. Weekly open, sell in the wick, and it crashes down. So all during a sell program, you're looking to look for sells. Avoid buys in a bearish trend. And avoid sells in a bullish trend. If you focused more on trend versus counter trend trading, then you'd make a lot more money. And all trends start with turtle soup right here. So the lower time frame is respecting bearish PD arrays. However, we have now reached, on the higher time frame, we've reached a higher time frame PD array, right? And as usual, rejection blocks give you a retracement before finally targeting the wick. That's another concept. So, are you bullish or bearish here? Pause the video. Think for 5-10 seconds, because that's the amount you should be spending before spotting something for it to be considered high quality. All right. Have you thunk? I know, of course, some of you didn't even pause the video. You were too lazy. But for those who did, your answer should be like this. If we close below this candle, we're bearish. Unless we close below this candle, we are bullish because it is a higher time frame key level. All right, so the concept is bearish on the lower time frame, and we've reached a higher time frame key level. All right, so we reached the higher time frame key level in confluence with a breaker, and higher time frame key levels, which are in confluence with lower time frame PD arrays, are high probability. So we go and crash down into the breaker. We then smack into it real hard, which is what I like to see. When I map a key level and we smash down into it, I like to see that versus slowly sinking and dragging it out, because normally when they drag price and it's really taking its time to reach the key level, then I consider that a less quality setup in general. So we have low, high, lower, low, expansion leg number 1. We've reached a breaker in confluence with a higher time frame key level. We close above this candle. We close above this candle. And from this moment onwards, you have this as your stop loss. The low over here. All right? Some things to note. The important prices to label on this chart when you have a change in the state of delivery is the open and the close. Right? Down close candle. They dug into this low. Confluence with this high, closed above it. Candles are ranges, right? So we have a breakout over here. That's why an order block works. Note this and this. Many a time you'll note this. You'll wait for a 1-minute reaction. It won't happen, and you'll say ICT sucks. No, you suck, because you're supposed to be expecting a deep dig into the order block, potentially the rejection block, and then it goes higher. Whenever there's an order block, always consider the chance that the rejection block does it. Excuse me. And as we see, indeed, we stabbed into the rejection block. Wicks do the damage, and bodies tell the story. We wicked into this order block. We respected the rejection block, because usually what you'll notice is that rejection blocks are usually retraded to more often than not. So if you have a long wick or even a stubby wick, right? If it's not a thick candle and there's any form of wick, then consider that price will go and fill that inefficiency, because that's what it is. It's a form of inefficient price which needs to be rebalanced. Now, next on to the topic of closes versus wicks. Close above equals higher prices. Close below equals lower prices. Wick below equals higher prices. Wick above equals lower prices. In this example, we have a range, prices ranging, right? Now, in every single range, we have a range high and a range low. What does this mean? This means smart money is accumulating. What does that mean? It means they're generating interest on both ends of the range. They're breaking down, and I like ranges to happen over an extended period of time. If it's 1 or 2 candles, no, it has to be multiple candles. 20, 30, at least 20, right? So I like price to range for 20 candles, and then accumulation, generating interest on both sides of the market. So we have buy stops up here, sell stops below here, right? We then dig deep into the sell stops. Everyone's bearish down here. In fact, this is also one I called live, but I don't think I was on Twitter back then, so I had to witness it with my buddies. Down here, everyone was very confident in gold being bearish. This is gold monthly chart, except me. And the reason was, this is a spring. If for those of you who have studied Wyckoff, that is one way to look at it, which is a spring. And my buddy, who is also a trader and an analyst, he told me that check out gold. There's a spring on the monthly, right? Spring, which is another way of looking at turtle soup. It's quite primitive. You can research it if you want, but it's quite a primitive level of turtle soup, not quite as deep and thorough as what I teach. Sorry, Wyckoff. Now, he's dead, so it doesn't matter. Now, the thing I want you to see in this one, and excuse me, the thing I want you to see is range, accumulation, manipulation, bullish from here, distribution. As soon as we close above, if you notice, all the way down here, we didn't close above, not a single candle. Below, 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 right? So when we close above, this is a change in the state of delivery. So now we have taken the range low. We're targeting 50% of the range and the range high. All right. In this instance, at the time of the creation of this order block, right over here, many people would have been buying at the open because they are pattern traders. Every single time I see an order block, I expect a deep dig into it and then a rally. And remember, we always mark the rejection blocks, right? Because there's a lot of liquidity that likes to rest at rejection blocks, right? Both bearish and bullish. So, how do you read this order flow? This is a monthly chart, right? You read it as follows. Are we closing below candles, or are we closing above candles? Closing below, closing below. Have we closed below the 50% of this candle twice? Nope. What is the important low which signifies a change in the trend from bullish to bearish? A close below this low, right? So unless we close below this low, you can't target any lower than the low itself, right? You can target this as a turtle soup candidate to the body or the wick, right? Because when you, for those of you who actually did the exercise I told you to do, which is removing the wicks, go to your charts when this is over, right? That's your homework, is go to the charts and remove the wicks and look at price through the lens of no wicks versus with wicks and see what you observe. So we're closing below this candle. Now, it is valid to sell or consider a sell at this order block over here. Right, we're closing below this, closing below this, closing. However, we do have a potential reversal zone at the rejection block, right? The opening price didn't support, the 50% didn't support, and the next stop is the rejection block, right? And it's a good example of
trading the PD array itself or the journey down to it. If the opening price is not being respected, then trade the journey down to the 50%. If the 50% is not being respected, then open the 4-hour time frame and trade down to the rejection block, and so on. So we're bearish right now. Yes. In this price leg, yes, we are. Clearly. However, this happened, which is the order block, which was bearish, has now failed. We've closed above. As soon as this happens, you now have a candidate. Of course, you have the rejection block. The body has been taken. You have a candidate for a kiss of death turtle soup on the lower time frame, and that is a model I've taught publicly. You can go to the public Telegram and check it out. And this is also another model of mine, which is the failed order block model. More on that coming this week, perhaps. All right, so now we have a clear directional bias. This is a failed order block, and it is one of the most powerful patterns, quote unquote, which you can trade. A failed order block will lead to an expansion to the high of the failed order block's price swing. If you didn't catch it the first time, replay. A failed order block. Right, so at the failed order blocks level, usually you'll have a not failed, a successful, a real order block, right? Fake order block, real order block. Because if we're disrespecting the bearish one, then we must respect the bullish one. There's no third option. All right, so the failed order block produces an attack from smart money on the high of the price swing of the failed order block. All right. Pair that with range high, range low. Target is going to be, this is a magnet over here. You have those equal highs. So the magnet is up here. And this chart is not some hindsight cherry-picked nonsense. This is a chart I traded myself, and I warned you where it's going to go. Right from here. So when you're down here, I had warned of I had freely given out money to the world by telling you that from this point onwards, gold is going to go to all-time highs. And over here, stick to the bias as long as we don't close below the rejection block. And of course, not surprisingly, range low, range high. Trading this, what would the anticipation look like? All right, so this is the real monthly order block, which is produced. You have the monthly opening price marked out beforehand, and you have the monthly order block marked out beforehand. Open, do nothing before we reach the monthly order block. We reach the monthly order block in week 2 of the month. As we know, week 2 and 3 have a high chance of producing the monthly high or low, especially week 2, right? And as we know, I'm looking for open, decline into key level violently. That's what happened. And at the key level, we show signs of bullishness. Right? Starting with this wick below, at key level, higher prices. And this is the framework, range low, range high, breakdown. Everyone's bearish. You're probably bearish if you're watching this right now. But every downtrend has to end at some point. Right? Every bearish trend has to finish. And that is what we are doing, essentially, with confirmation. So from here onwards, it saw nothing but up-only price action. Of course, range, beautiful. There's always a range at the high and the low of the candle with an SMT. Always. Open, decline, smack into key level. Candles and ranges. Range down here, range low, range high. So range below range low, range high, range low, and we rally violently from there onwards. And this was another Monday low of the week. Remember, you were on the last presentation. Same thing. Sunday, Monday, Tuesday, Wednesday. Well, Sunday. Monday, Tuesday, Wednesday mark the low of the week. And Thursday, Friday mark the opposing end of the range. Another example of order flow being bullish or bearish until reaching a key level. Over here we have a daily chart. Closing below candles, respecting bearish PDRAs, disrespecting bullish ones, so we're bearish. But we're only bearish on this time frame until we reach the higher time frame weekly key level. Right? And at the higher time frame weekly key level, we look for a close above. All the way down here, almost 2 weeks. Right? Not a single close above the candle was happened. Right? There was not a single candle closing above a previous candle. Close below, close below, close below, close below, and so on. Until this point, we came here, we closed above this candle's high and this candle's opening price. Right, it's an order block. Candles are ranges. Wick through the range. And now we're closing above the opening price. Using that opening price and this candle's high as a pivot point for a potential entry. Right? So from this moment onwards, we're looking for a classic buy candle. And we were bearish all the way down until we reached the higher time frame key level than the current time frame. Close above and rally. Bump in the previous candle's high. And that's all she wrote. Now, where does turtle soup fit in? The answer is everywhere. Turtle soup above this high. Turtle soup below this low. There's always a turtle soup and or a failure swing in every single chart you see. Going back to the previous examples, skimming through them. Same thing, turtle soup, turtle soup, turtle soup. It looks cherry-picked in hindsight, but this is a trade I took by myself, and you've seen me call this for the past year with an accuracy of over 80%. A little bit over 80%. That's something you will never see anyone do, ever, on Twitter. Unless they are one of my mentees, then perhaps. But don't be discouraged if you see the turtle soups after the fact, but you seem to struggle seeing them during the fact. That's normal. That is part of the development, and you must persist and ask yourself why. Is it because you're blindly entering? Are you looking for SMT? Are you looking for a change in the state of delivery? Are you waiting for closes? These are all questions you should answer yourself. As I said before, you have the open. This is how I view any candle I trade. All right, and this is a deeper look into my brain. Open. Rally. Excuse me. The first voice crack in this mentorship. Open. the higher time frame daily is bearish. Open, rally, range, turtle soup, decline. That's during 1 o'clock onwards. And then you have this. At 9 o'clock, you expect a rally, turtle soup, and continuation. All right, expansion leg number 1, protraction, expansion leg number 2. And that marks the end of chapter 7. Good luck. Good studying. It is very dense, so study it well. Repeat it a couple of times, because there's no way any of you grasped all of that in the first take. So study it again. Some of you reverse engineer everything I do and say. That's the best way to learn from someone. If you want to emulate them, do that as well. And really take notes. There's a saying in Arabic. It's العلم صيد والكتابة قيده قيد صيودك بالحبال الواثقة, which translates to, knowledge is a prey and writing is the net or the rope. Catch your preys with thick nets, or thick ropes. And on that note, I wish you good luck, good trading, and see you in the next one. Whoever's volunteering, it has to be HD.
The N1 dude, I think,
Yes.
I mean, 4 people recording, so at least one needs to have it.
I'm also recording, right? But it's always better to prevent than cure. Prevention is better than the cure. All right, folks. Welcome to the Q&A. This is taking into account all the questions I've received through myself, through Giuliano, through Rich, through Villa, through Adam. Right, those are the mods of the chat. These are the summary of the most important questions, and pay attention, because it's going to be this session, and then not the next week, the week after, I'm going to have another session, which was not included in the course, but I will give it to you from me, because I think you will find it beneficial. Right, so the technicals are fine, but more important than that is studying the mistakes. Right, study why traders fail, not why they succeed. Can you see my screen?
No.
All right. Can you see it now?
Not yet.
All right, the format, folks, is going to be like this. Adam will read your questions, the most common recurring questions, and I will reply to them with a chart. All right? So, Adam, are you ready?
Yes, I am.
Share screen. Can you see now?
Yes. Normally.
All right. Let's
Yes,
start
yes.
with question number 1.
A question, the most asked question was I shorted above a high or I bought below a low, and it kept going against me, like nothing happened. It goes straight to my SL. Why is that?
All right. So, for example, you bought at this low, right? Because turtle soup, right? You've seen me do it all the time. So you bought here, and it kept going down. right? This is a very common mistake to make at the beginning of learning turtle soup, which is trading the pattern, which is going back to any previous high or low, right? And just randomly buying or selling. That is incorrect, and that is what I saw someone in the chat do, right? You're saying I short an old high and it kept going higher. That's because you had an incorrect read on the higher time frame order flow, right? So the mistake is or the sickness is I shorted an old high and it kept going higher. Very common mistake. If it happens to you, don't worry. It happened to me as well before I learned the intricacies of turtle soup. And it will happen to anyone trying to learn at the beginning. And it probably happened at least once to every single one of you in the stream. Right? This reminds me of a saying, which is, the master has tried more than the student has failed. Right? So failure is part of the road to success. Now, the mistake is this: the solution or the reason why you made the mistake, and that is what you want to study. The reason, the fix, the medicine to the sickness is correctly following higher time frame order flow. That's a surface level answer. Now let's go deeper in that. As we know, the markets, we have trending markets, in a downtrending market, in a bearish market, in a selling program, right? Whatever you want to call it. Highs are rejected and lows are broken. Highs are rejected and lows are broken. Highs are rejected and lows are broken. Right? Why does this happen? This happens because you are trading a higher time frame key level. So the higher time frame order flow is bearish. Therefore, you don't look to buy at lows when the higher time frame is bearish. You look to sell above highs. Right? The trend is your friend until it ends is a true statement. It's a cliche, and it's a cliche for a reason. Right? So if the market is poised to go lower, you don't buy at lows. You expect lows to be broken. If the market is poised to go higher, you don't short old highs. You expect old highs to be truly broken. You expect distribution above old highs, right? This also goes back to manipulation versus distribution. You thought it was a manipulation when in fact it was a distribution. That is the technical reason for the mistake. Right? Nothing is random, and every single thing can be explained if you have a curious mind, which is curious enough to investigate. Right? Example. So now you have the reason, you have the theory, and now a chart example of why this happens. Let's go to Euro. Step number one is the market poised to go higher, or is it poised to go lower? Let's go to the monthly. The monthly tells me that there's an inefficiency at this closing price and the 50% of the wick. And the astute pupil will recognize this 50% of the wick. Now, so the market is poised to go higher, right? Over here on the weekly time frame, we have reached a down close candle, which is on the monthly time frame an IFVG, right? For you to see. And we are showing a willingness to expand higher. We smack down into a key level on the higher time frame. We close above previous candles. And a mistake I saw a bunch of you make in euro at this time was trying to short at this high over here and short at this high over here as well. If you shorted at this high over here, you made some money. Yes. Why? Because a signature in price, a very common theme and a signature of smart money is before breaking out of a range, a true breakout, you will usually find a sharp decline at the range high, right? So range low, range high, turtle soup. And before breaking out, there's a sharp decline and then it breaks out, right? That is something you will notice if you study ranges in depth, right? Before a breakout, what happens? That happens. So if you try to short this high only because it's a turtle soup, then you are wrong and you are a turtle soup pattern trader, which is not what we are doing, right? At first glance, it makes sense. However, we are rejecting this low at a higher time frame key level. Right? There's no reason to be bearish at all. If lows are being rejected, then we expect highs to be broken, right? If the higher time frame, and note this down with a notebook, right? Stop casually listening, put down everything, and write this down. If the higher time frame is bullish, then the lower time frame highs will be broken and the lows will be rejected. And vice versa. And this is not some hindsight. This is something I called live on Twitter, as usual. That distinction has to be made. Now, that answers question number one, right? Which is, in summary, the mistake is you shorted at an old high and you messed up. Or you longed at an old low and it kept going lower. Over here, for example, you bought here and it just kept declining. Why? Because if the higher time frame is poised to go higher, and that is step one, which is determining, are we more likely to go higher or lower on a higher time frame candle? If the higher time frame candle is poised to go higher, then the lower time frame lows will be rejected, and highs will be broken. You expect manipulation, but what you get is distribution. It's a misread, right? Something you should reflect on and fix. Next question.
Also, another common problem people are facing is getting getting missed on their entries, like waiting for a high and then that high never gets hit, and it goes to TP.
Fantastic. So this is another mistake which happened right over here. Right? And as you know, I'm a higher time frame, relatively speaking, trader, which means I like to catch the beginning of the moves and hold until the end of the move, right? Which is why I have an entry up here on euro. Right? That's my entry. At major swing points is where I look to enter. the question is
getting
like
missed.
my entry gets missed. For example, I expect a high or low to be swept, and it doesn't get swept. Right? That is that's a valid question, and the answer is SMT. So the mistake is missed entry, and the answer is SMT. One of the main reasons, right? Of course, the first answer, which should not be applying to any of you, assuming you're all advanced, right? The first answer should be incorrect read of order flow, right? But assuming everything is intact, you missed an SMT. For example, let's look at this one over here. So I like to use examples of charts I've called. That's some hindsight garbage. So over here, many people were expecting a third drive in Euro, right? Like, you should ask yourself, and it's a valid question. Why is this low, why is this low left untouched? Forget everything. Forget all, forget all the ICT, forget everything. Why is this low? Investigate. Why is this low unlikely to get traded to again? In other words, why did I come and say I'm scooping up some Euro down here? And you can go and verify it on Twitter right now. Why did I buy a Euro over here publicly? What gave me the confidence that this low will remain untouched? Because that's a bold statement to make, which is this low is a stop loss, right? It's an area we are unlikely to trade to. Why? The answer is SMT. So if you're waiting for an entry down here, you missed it. All right? Perhaps you had this marked out, a previous high. And you're waiting for some sort of dig deeper, or you had the opening price of the weekly candle marked out, which are valid. But why would you abandon that as an entry point? A missed entry. SMT. Down here at this low, I haven't seen it, but I'm pretty sure there's an SMT down there, which deters me from
Also,
buying.
GU took the lows on Wednesday.
Yes. Right? So this is the reason why one asset takes the low, the other asset is expected to not take the low, right? And GU as well. As you know, each market has co-related assets. In case of Forex, it's EU, DXY, GU. Very basic knowledge. Right, so if you hadn't looked at both the charts, then you would have waited for this low to get swept, right? And that is, it goes back to another topic, which is rejection blocks. When do you use a versus when do you not use it, right? And another thing is, from a market making perspective, you have the classic pattern, quote unquote, which is a turtle soup, right? So everyone's sold down here. You probably, and you shouldn't if you're following me, but this looks bearish, right? You would target these equal lows, but that's pattern trading. Smart money is buying down here, right? So it's manipulation. everyone sold, dumb money sold, and the rejection block is taking out, sweeping the body of the candle, because when you have long wicks, then usually they will stop at the body. Turtle soup over here, failure swing, and SMT produced an expansion. The diagrams on Twitter for this one, if you go back a few days, there's an excellent explanation of this. Turtle soup. So scare them here, and then further scare them over here, and take off without them. Your confirmations are closes above or below levels. All right. Excuse me. So that's the answer. If you have a missed entry, right, you marked a level and you wanted to hit and didn't hit, then it's either an SMT divergence or it's a misread of the order flow. Next question, Adam.
Also, one of the things yeah. This one was very common too. It's getting stopped out and then going to take profit. Hitting the SL and then the GP.
All right. So the mistake is my stop loss gets hit, right? And then it goes to my target. There's an analysis reason for this, and there's an execution reason for this, right? The execution reason is you had a stop loss too tight logically, right? Because if it, and I say this often, which is if you go back to your mistakes you made in your journal, and you should have one, you'll notice that a lot of times your stop loss was an excellent entry. The reason is you have an inadequately placed stop loss. It's too tight. You are getting greedy. A lot of mistakes in trading can be boiled down to fear and greed. FOMO, right? Those three things. So in this case, your stop loss is too tight. If you increase the size of your stop loss, then you would have a much higher strike rate. Next question, Adam.
Also, yeah. When does a key level gets hit two times? Like, when does it go to break even and then goes up?
Okay, so the
When
question,
to expect two taps of the key level and when to get one tap?
all right, when do I expect two taps of the key level? And when do I get one tap? This is a multi-layer question, and it has a multi-layered answer. The main reason and how to actually get down to this is understanding what times are more prone to giving you a violent trend. There are certain times of the year where the trend is expected to be violent, and there's certain times of the year where we expect chop, right? So and I'm doing some extensive research on these because it's not simply it's not as simple as it sounds, right? Because what you're trying to predict is essentially when to expect a V-shaped reaction from a key level, right? That's a themania, a V-shaped reaction from a key level, or when to expect an M-shape, right? Because we know that key levels can only have 3 different types of reactions, right? And this one is another from the notebook. A key level can only have 3 different kinds of reactions: a V-shaped reaction, whatever it is. It's an OB, it's an FVG, it's a breaker, whatever. It doesn't matter. It's an 618 fib. They can only have this a V shape or a W shape or M shape, or it can have a multiple reaction, multiple touches, right? So the number of touches a key level has are as so. You want to try and catch these two as much as you can, right? And there is a method to time which one happens when. Aside from that, a double touch of a level on a lower time frame is one touch on a higher time frame. Because you always have to think about the fractal nature of price and how the higher time frame looks like on the lower time frame. So, for example, this order block. As soon as we closed above this, and this was a private trade I took, I gave you all a public trade right down here at this low, and I gave myself a private trade with a little bit higher risk to reward, because that's how it goes. So, for example, the alignment of all the elements of a high probability trade are present in USD CAD at this point last year. We close above the candle, right? So we're bullish. From now on, we're bullish. The novice trader will think that I need an instant reaction and to rally in one big candle up until these equal highs. That is not correct. Smart money needs time, right? When they produce such a signature, they need to accumulate inside the signature and then rally. So if I'm expecting this candle, this order block, to produce me an expansion, then I put the stop at the bottom of the order block. I mark out the 50%, and I wait for them to expand from this one specific candle, right? So why play around with the stop loss? Why wiggle around? And tight stops are a direct result of underfunding of the account. Let's assume you have $100 million under management, right? It's a relatively large amount. It's not the largest, but it's a decent amount to have under management, right? If you have $100 million under management, then the nature of the game requires you to have a wide stop loss. So I'm comfortable having my stop down here because I know that I'm going to get an expansion from this one specific candle. This one candle is getting me an expansion. So I'm expecting, because I've seen it happen millions of times, for them to accumulate inside this order block and expand from this order block with a 50% as a line in the sand. If they close below it, then I doubt the quality of the setup. Right. So this one specific candle is the candle I'm expecting to pay me. There are methods with extremely high risk and reward when you time the tops and bottoms to the second, even to the minute, at least. That is possible, but that requires an immense amount of skill It's a very advanced topic. So most people, most of you listening right now, you are better off starting like this, using the zone as a stop loss, not one specific candle inside the zone. Right? Write that down. Which is using the key level as a stop loss, and when you see success with that, then you promote yourself, then you allow yourself the luxury of looking for a tighter stop loss. Because if you can't even succeed with this wide stop loss, then the chances of you succeeding with a tight stop loss are much slimmer. And wide is relative, right? This can be a 1 hour time frame. This can be a 15-minute time frame. Right? As you know, practicing on a low time frame is a good way to get in a lot of reps with the charts. So, and one more thing, excuse me, is pyramiding. So if you have a 1 to 5 over here, and then as soon as you have this fake order block confirmed, then you have another 1 to 4. Pyramiding is the pinnacle of the charts. If you have a price, like a range framed beforehand, so I have these equal highs, right? The seasonal tendency, the quarterly shift, everything is pointing towards a run towards these equal highs, right? Then the highest level of skill is milking all these candles on the way up by pyramiding, right? I've given you a massive clue in pyramiding through entry 1, turtle soup, entry 2, order block, entry 3, breaker, right? That's an edge which no one else speaks about. And if they do, then it's from me. Right? They saw me say, now they're saying it, as they have with many things. So, in summary, always expect at least a double tap with a turtle soup or failure swing in a key level, and practice with using the key level as a stop loss first. And then you move on to pyramiding and lower time frame, higher risk to reward setups, right? But step by step. There's no rush. This is a skill. If you take time to hone the skill of trading, then it stays with you forever. Once it clicks, once you master the model, once you truly understand your model, the one you choose for yourself, whatever it is, whether it's 3 a.m., whether it's 9 a.m., whatever. But once it clicks, then it's yours. No one can take it from you. I can't, even though I taught it to you, right? So put in the time to sharpen the blade, right? It will never, you will never regret the time you spent honing the craft. Never. Excellence is always rewarded, and competence is always compensated in every field of life. And what's the final question, Adam?
Uh, Also, yeah, people are asking. Yeah, they say, how do I determine the higher time frame bias in narrative? Like, how it's like the first step. How? Yeah, yeah, that's common too.
The higher time frame bias and narrative. First of all, you have to understand what is bias and what is narrative. Bias is where is price going, and narrative is why is price going over there. Right, and for that, I would direct those asking that to watch chapter 7 again. It is a gold mine of information when it comes to higher time frame bias determining, and chapter 7. In summary, focus on the highs and lows, the closes, and keep in mind, for those of you who are willing to indulge in the higher time frame trends, that every 3 to 4 months there's a shift in sentiment, right? And keep that in mind when framing a higher time frame bias. It's crucial. And practice practice anticipating what the next weekly candle is going to look like. That is also very important. Any more questions, Adam?
These were the common questions. Also, people were asking about do you call it trade management stuff and stuff like that.
Yeah, that was covered in the pyramiding just now.
Yeah. So yeah, that's why.
That is covered. And another good way, another excellent method, excellent resource of narrative, especially why should price do it, is level 2. I saw a lot of you struggling. Not a lot. There's a bunch of you in the group chat. You were struggling with the concept, and Giuliano and Rich came and said that level 2 was a crucial element in understanding this one. I wouldn't say it's a critical element, but it certainly helps. It is a very good piece. And when it comes to framing a trade idea, that is the best piece of work I've put out. I will try and top it in this one, of course, in the upcoming weeks. As you know, we have the exam coming next week. And the week after, I have another video, an extra video by me, which I'll be putting in this channel. So stay tuned for that.
Also, for everybody else spamming me, I only ask the common questions, the ones that everybody wants answered. So if you're asking me why did I get missed here, Tuesday didn't hit the thing, you will get that from experience or from rewatching the other levels. So stop calling me. There are niggas calling me right now. So please stop.
I hope you're African, Adam, for saying the N-word.
Yes.
Fantastic. Okay. Okay, let me see the notes. Yeah, we hit all the topics required. If you have anything else you want to say, let me know. Any other thing people have been asking you? Any collective question which I may answer?
Also, people are asking level 2 how to join.
How to join level 2. It's on the website. If you go to romeospeculates.com, it's in the bio of the Twitter account. All right, so go to Twitter, click the bio. You'll see Master Turtle Soup and level 2 advanced over there. All right. Anything else?
Don't think so.
All right, folks. That went a bit longer than anticipated. Again, like with everything, rewatch it at least 3 times with a pen and paper in hand, because that is what the most successful mentees have done, which is be almost obsessed with learning. That's the only way. If you try and half-ass the learning process, then you will end up with nothing but another strategy you hopped onto and to another one. So be aware of that. I hope you found this insightful, and I wish you all good luck and good trading, and see you all in the exam next week. Good night.
Okay. So if other questions, they will be answered later. Okay. So this session is over.
One last thing before I leave, because I'm going to get my dinner right now. If you have any more questions, then ask Adam, right? And for the session, which is not the next week, the week after, I will have them included in his questions. All right. Good luck, good trading, and good night.
Okay. Goodbye. Take care. And guys, stop calling me, alright?